Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, so I'm excited today. I've got a great guest. His name is Kevin Jiang. He's at Mangusta Capital. Really excited to have him on. New friend. We've been, exchanging discussions about just kind of firm building. And one thing that I'm really excited about is just kind of learning his story. I'm going to give a high-level overview, and then Kevin's going to go a little deeper. Kevin, number one, welcome to the show. Kevin is a co-founder and managing partner at Mangusta Capital. It's a venture capital firm investing in consumer and vertical AI businesses, shaping the future. Before, he's worked at some amazing top-tier funds. So obviously, everybody knows about the SoftBank Vision Fund. And then before that, he spent time on the private equity team at Apollo Global Management, which is also another top-tier private equity firm. So Kevin, welcome to the show. Thank you for coming. I think we have a lot to unpack. You've done a lot of travels as well, so I feel like there's insights that you can share from that as well.
Awesome. Thank you so much, Joel. It's a pleasure to be on the show and really excited to collaborate with you on Sutton Capital's program going forward and all the things we can do together. Yeah,
really super excited, so just to double click on what Kevin's, mentioning here, we run an accelerator for fund managers and we're on our 10th cohort. So happy to have Kevin along with a lot of amazing other fund managers that we can learn from and build friendships with. But Kevin, why don't we just take a step back? You probably haven't done this in a long time. And, sometimes it's fun to do this, but just think all the way back to your childhood, man. I mean, tell me kind of where you grew up, what you studied, what you thought what industry you thought you'd get into. If you're comfortable with it, tell me about what your parents did for a living, what their background was, what their thoughts were, and tell me kind of a little bit more about that journey of like kind of where your self-identity, your concept of identity was, and it's like, look, let me figure out where I want to go, and walk us through all these different roles that you had in high finance and how you started to build this firm. And then I might interject in between.
Yeah, absolutely. And I'll try to keep it relatively brief. Doesn't otherwise we'll go for hours probably. So I grew up in Silicon Valley, in Cupertino actually. My parents were first generation immigrants. They came here from China and they came here for undergrad and grad school. And, I just basically, grew up in the Bay Area, fascinated by everything that was around me. They were both engineers at semiconductor companies here in the 80s and 90s. And as during that period of time, it was kind of like the first tech boom, post World War. A lot of semiconductor companies had switched from, their functions of kind of defense contracts to much more consumer applications, enterprise applications for a lot of those chips. And so, my mom worked at companies like Maxim, Micron. My dad worked at Cisco, a bunch of other, Lucent, and some names that are here, some names that are not anymore. Sun Microsystems as well. And I was just like, okay, this is super interesting, fascinating. Like everything, property prices are going through the roof in the Bay Area. People are doing IPOs and companies are going public and people are getting very rich. And like, what is all this and how does it all work? And so I was fascinated by it from a pretty young age. Like any good Asian, my parents wanted me to be a doctor, lawyer, something, just like a grad school degree, more or less. And so
it's funny, like being, I'm from India, right? So, I mean, we don't get the lawyer push that much. It's either medicine or engineering. And I'm an engineer with a PhD, right? So the difference with my father was like, he didn't, once I started pursuing my PhD, my dad's like, what are you doing? Like, how come you're not married yet with like 2 kids, So it's like, once you get the education, it's like the pressure to get married. But why do you think that Asians think about like pushing kids to kind of be lawyers and doctors versus like doctors and engineers? Is it
Well,
just
I think engineer is very, very plausible as well.
yeah,
I think the problem was like I just wasn't like I wasn't super, super good at math. I was fine
yeah,
at math, but like I wasn't, a math Olympiad champion, which, in the Bay Area is kind of like the stand now. The benchmark for like good at math is like quite high, right?
yeah.
As you can imagine.
I feel like
So,
it's also maybe a status thing too, right? I mean, the parents
yes.
want to brag and say, "Oh, he's my son Kevin's a lawyer." What does your
Yeah.
son do,
Well,
right? So,
yeah, I think the reason is actually any hard science or any hard degree
mhm.
they would have been fine with, because the
Yeah,
idea is that if you have hard skills, like technical, quote, hard skills as in like technical skills that no one can take away from you, then you have some value to add to whatever field, whether it's medicine or law or something, right? Or engineering, technology. Like you have some hard skill that no one can take away from you, and that should
yeah.
theoretically guarantee you a stable job with a stable income. So I think that
I
was
would say back then too. I feel, and this is just based on my memory. I don't think engineers were paid that well back then,
Hmm.
right? I mean,
Yeah, back
now
then
engineers,
probably not.
yeah, they're
Yeah.
making like 50. I had an uncle that was an engineer, and back in the day, I mean, he was probably making the same as like a nurse. I mean,
Hmm.
engineers did, back in the day, they're probably making close to six figures later on, but like when they start out, I think they're making 50K. But lawyers and doctors, obviously, people think when you just think from an optic standpoint that you're rich, right? If you're a doctor or a lawyer, especially in like an Asian parent's mind, and I think for them it's more of like a status thing. But now it's different, right? I mean, there's probably doctors going to coding school, maybe wanting to change careers and become a
Hmm.
data scientist, right? Data scientists are making like what, like 800 grand or something or more at some
Yeah.
point. So yeah.
Yeah. No, it was definitely a different time.
Mhm.
And so anyways, I just was still fascinated by it, but I think there was always this pressure to do something like, maybe more do pre-med stuff. And so I actually did a lot of science research when I was in high school. Did a bunch of I worked at Stanford for a summer, I worked at UC Davis for a summer, and was very hardworking, good student. So ended up gratefully being able to go to Harvard and study economics for undergrad, because once I got to school, the world just kind of opened up. Basically, I met
Mhm.
people who were working at places like Goldman, and I'd never heard of Goldman before that. I'd never heard of McKinsey before that either. Growing up in Silicon Valley with parents being two first gen kind of engineers, like that world was just completely foreign, right? They'd never heard of it.
Yeah.
And so I met folks that were doing business and finance and investing, and I learned what a hedge fund is. And that's when I really started to figure out, okay, well, where does my skill set fit, and what am I really interested in? And at the same time, it's like my parents, I'm sure, would be happy for me to enter any of these careers, because I think it would be a very well regarded and well paying career. So it's like, I knew that they wouldn't necessarily be against me going into one of these fields. And I think I would be a lot more interested and a lot better at a lot of these things. And so I started exploring. I did a venture capital internship. I did a hedge fund internship. I worked in investment banking for a summer. And basically what I took away with it was, the first place to start is really investment banking or consulting if you want to get a super strong kind of financial background. Especially coming from a liberal arts school like Harvard, there's no accounting, there's no finance or business classes.
Mm-hmm.
So you really have to kind of, learn kind of on your own or learn on the job. And so the first job that you get is pretty important. And so I was like, okay, well, investment banking programs have, hundreds of analysts go through it. They have a very structured program. It's going to be a great way for me to learn everything I need to know. And so I joined Goldman after graduation, went through their program, and as you may be aware, typically in private equity investment banking, the headhunters start calling like day one on the job.
Sure.
The headhunters start calling all the analysts, the investment banking analysts, and asking, "Do you want to go to a private equity fund? Do you want to go to a hedge fund?" And so I went through that process, and basically the day I hit the job, and got an offer to join Apollo in their private equity group after Goldman. So that's what I did. I ended up finishing out my program at Goldman in New York, and then I went to LA, worked at Apollo for just about a year actually, so it's pretty short.
Yeah.
And Apollo's obviously a fantastic firm, amazing brand name. They have been extremely successful at what they've been doing, which is value-oriented leverage buyouts for decades.
Yeah.
And built. I mean, it's a public company, built an amazing franchise. But for me, I just quickly realized like it's not the tech that I was doing at Goldman, and it's not the tech that I really want to be doing, because it's very value oriented. It's a lot more mature kind of companies, not growing companies, oftentimes in sectors that are in secular decline, because you can often buy those businesses at a cheaper multiple, which was really the core philosophy of how Apollo would think about investing. Much more value oriented. And so after that, I started thinking, okay, well, what's next? What should I be? Where do my skill sets lie? And what's going on in the world? And I think the advice that I got from a Harvard alumni, which was super helpful, that I always pass along to everyone that I talk to, like younger folks that are interested in figuring out what they want to do, is try to triangulate three things. So the three things are: one, what are you good at? Two is, what do you enjoy doing? And three is, where's the world going? And try to find something that fits in the center of all of those three things. Obviously, it's not going to be perfect, probably. Like, no one can also predict where the world is going. But the best advice I got was try to triangulate something in the center of that circle, because from then on, I thought a lot about, okay, well, what skill set am I really good at? What do I enjoy doing? And where is the world going? And I can't, I won't take full credit for joining SoftBank super early and kind of preceding a lot of the gold rush or the huge upcycle in growth equity and venture capital. But it was clear that buying kind of dying businesses in secular decline is probably not where I wanted to be. And coming from Silicon Valley, like, I just knew all the growth and excitement that's happening in the technology space. And so I just knew that's probably where I should be. And coincidentally, at that time, SoftBank and Masa were raising the $100 billion Vision Fund. And so I had gotten a call from a headhunter from a close friend of mine, that was referred from a close friend of mine from Goldman. He was like, hey, you have to talk to Kevin. He's thinking about moving back to the Bay Area. He wants to do VC stuff. Like, this would be a perfect fit, because it's effectively like a really well-funded, exciting, growing startup, right? Because at the time it was a blank slate. There were no, there's no investments yet. There were no super high-flying kind of names in the portfolio. And so I was like, well, this is kind of interesting. You can like shape it a lot. And the team was very small. It was like 4 or 5 people. So you would come on the ground level and be really able to build everything together, right, from the ground up, and have much more of an impact. And so, I joined, and it's been, nearly 10 years, and I loved it. I was able to meet with Masa in Tokyo a bunch of times, bring founders to him, led a couple of deals. Like, it's just such an amazing experience being able to work with, a genius and a visionary like that. And don't get me wrong, I'm sure, he has his flaws, but he's just such a unique, amazing individual that, I think every minute that you get with him, to spend with him and kind of do deals and investments together, is just it's so valuable. And so over the last 10 years, I've, had an amazing experience, built out a great Rolodex in the venture capital space, and, was able to, lead about 12 of our deals, sat on the board as a board director across all of those as they, continue to scale. And some of those are hopefully going public this year. But I think over time, we all saw just the developments in the growth equity space getting more competitive, more saturated. everyone was raising multi-billion-dollar funds. Sequoia and Andreessen, everyone, Tiger, Coatue, everyone was coming into the fray. And I think over time, you just saw a lot of the excess kind of play out in the market, right? Both in the public and private markets. We went through a pretty rapid meltdown in 2021, 2022, and 2023, and for me, that was very much a wake-up call as well, which is I love this asset class, I love the work, I love what we're doing, but I think there's going to be a lot of pain, and there's going to be a bit of a kind of outflow for the next few years. And so, where do you think I can? Where should I actually be playing? Where I feel like there's still good opportunity, and I think I realize it's probably earlier stage. It's pre-seed, seed, Series A. At that stage, unless you're trying to fight with Sequoia to get into like the pre-seed round of Vlad's new company from Robinhood, and give him whatever valuation and whatever check size, blank check, you want to play that game? Yeah, it's tough. But otherwise, it's pretty greenfields out there for you to really succeed as a pre-seed seed investor, because the whole world is your playground and founders come from everywhere. And if you have a way to source and find that deal flow, build really great relationships with these amazing founders the day they start their journey, they really appreciate it. And they're going to appreciate you even when they're a unicorn too, because they'll remember, he's the guy who believed in me when I had nothing, when I was just starting and I just had like MVP and one customer, and now we're a unicorn with billions of revenues and we're doing great. But like, he was the guy who actually first took a bet on me. And I've already seen that kind of play out in a couple of my portfolio companies that invested at a pre-seed stage. They're going on to Series A, Series B, and they like still just really value my advice and the relationship they have with me. So I think it's just a completely different ball game from growth equity investing, where they're just going to go around to the top 10 shops that have the best brand name, that have the most capital, that have the biggest checkbook, and they're just going to go around and say, okay, here's the valuation, you in or you out. It's a very like mature kind of field.
I mean, they're looking for the founders looking for the highest valuation and probably the best brand name and the best terms, right? I mean, sometimes the exit, if it's an acquisition, it might be like half cash and half equity, right? So I'm assuming, I mean, what do you think the founders would be filtering for if they're trying to find the best alpha? I mean, I'm thinking like the highest valuation at the biggest cash offer. I mean, in my opinion, but I don't know, you have a little more of a lens.
Yeah, it depends, right? It kind of depends what that founder's looking for at that point in their journey. If they're looking for secondary, it could be they want to cash out a portion of I mean, it's fair, right? They've been private building the company for 10 years. They haven't taken any cash out of the business. Maybe they want to take some secondary off the table. So it's like which funds are willing to do that? To be honest, most of the funds are willing to do that nowadays. So I think everyone, all the big names, SoftBank, Coatue, Tiger, whoever, happy to do a secondary and return cash to the founders if they want to take some off the table. It's brand name. I think that's always something that people care about. So obviously, but the thing is, at that stage, like, what's the difference between a Sequoia versus an Andreessen versus a Coatue or a Lightspeed or name any number of like brand name firms? Like, they're all, I don't know, in my mind, they're all kind of the same. I think the only maybe stands out is Sequoia, but like outside of that, it's like everyone has a decent brand name. Are you like, what are you really optimizing for there?
I mean, even Goldman's got a pretty big growth equity arm as well. So, I mean, a lot of those larger funds at that stage, because I've done some pretty large secondary late stage deals, and like, a lot of those deals at that stage too, half of it is debt, right? So there's like a large bank that's coming in doing like a big portion of like mezzanine debt, like combined with the growth equity investors as well.
Yeah, exactly. So it's a combination of valuation, I think, check size, brand name, but honestly, it's hard to really differentiate. In my opinion, it's like most of these growth firms as well are pretty flexible when it comes to all of those things. Like, they have big checkbooks, they can write high valuations. So it's almost a question of they set the terms, who wants to come in. So you see a lot of these late stage party rounds where they'll list everyone in the valley basically, because it's like you just decide how much allocation you want and just
Yeah.
come in for that amount. It's almost like an IPO in some
Sure.
ways when you think about it, because it's like you basically, the company sets like the IPO price. Here's the range that we're talking about. And then the buyers or public markets investors will say, okay, the Fidelities, BlackRocks of the world, they say, okay, how much do you want at this price? Okay, I'll put in my bid. I want 100 million allocation. I want 200 million allocation, whatever it is, and then they size you down or up appropriately. Be like, okay, well, we couldn't give you 100, we'll give you 50 or whatever it is. Like it almost operates. It's funny. I never really thought about it, but it almost operates in that way.
Yeah.
Yeah.
I mean, their positioning, I mean, that's essentially what they're doing, right? In those growth equity rounds, I mean, many of them are not ever going to be profitable, but there's some of them that are kind of gearing up for the IPO, so they're kind of really looking to kind of get a little closer to some type of EBITDA positivity, but they're kind of essentially preparing for the IPO in that stage. Or once you get to like the Series E or Series F, a lot, and that's how like a lot of these late stage, a lot of people that are doing these SPVs, they're trying to position it that way. It's like, hey, we're looking at like an IPO in 2 years, so they're trying to plan for that process. So
yeah. Maybe I'll finish out I realize we went off on a little bit of a tangent.
No, it's fine.
But I'll finish out my kind of background. So basically, about 6 months ago, I spun out from SoftBank. Started an early stage VC fund called Mangusta Capital, and Mangusta means mongoose in Italian. And so my anchor LP is a family office that's behind Luxottica, which is an Italian founded business, now global. It's the world's largest eyewear business. So they own Ray-Bans, they own Oakleys, and they also basically work exclusively with every major luxury brand globally to produce and distribute eyewear. And it's funny because it's a business that not a lot of people have actually heard about the holding company, but people are very familiar with the brands and the distribution channels. In the US, for example, they own Sunglasses Hut, they own Lens Crafters. And so they're very, very vertically integrated, but no one really knows that they're this huge behemoth in the eyewear industry. And so the principal of the family office there is our anchor LP. And yeah, so since then we've been focused on early stage AI investments on the application layer. So what I would describe it as like kind of vertical software, except using AI to really, really enhance the capabilities of that software or technology that's able to deliver significant value across various industries. So we're industry agnostic. We'll look at every single industry, but we do want to see that the companies we invest in have a significant industry focus in one area, because we think this verticalized sector approach actually results in the ability to monetize a lot faster, generate revenues, and then two, also opens up a lot of exit pathways for our portfolio companies in the future when they have such a strong industry focus. There are a lot of public incumbents, late stage, large businesses that are interested in acquiring technology and AI solutions such as these to really enhance their talent, enhance their product set. And so that's what we're really looking for and setting up a lot of our companies for, is the ability to actually be able to be a great acquisition target for some of these industry incumbents. We invest pre-seed through Series A, so relatively early stage, $500K to $2 million first checks. And then after that, we reserve about half the fund to double down into our winners. And so continuing to get more exposure into the top businesses in our portfolio. Invested in about 8 companies in the portfolio, and continuing to do a lot of new deals. So we'll probably see another 5 to 10 kind of investments that we'll make this year.
No, that's great. I think one thing that I'd be interested in learning is a little more about what some of the biggest takeaways from working with Masa. I guess if you were to look back, are there any kind of glaring memories or just kind of life lessons or professional lessons? You were there for a decade. So
yeah, no, absolutely. It's interesting because I think probably the main lesson that I learned from my time there is when you're investing in startups and growth companies, whether it's early or late stage, the most important thing is the founder. Like it's people, right? At the end of the day, this is a people business because you've got to build the relationships with the right folks and build really strong relationships with these people that they trust you, they want to work with you. And second, it's you've got to recognize who are the right founders for the right time in this, company's development, and what are they good at, what are they not good at, are they surrounding themselves with the right team to help support them once they scale to a stage where maybe it's not necessarily the right fit for them and it's not necessarily their right skill set. And so it's all about just management, evaluation, assessment, and how do you work across very, different and difficult situations with people. And so really, I think that's kind of the biggest lesson, if you had to ask me, that I learned, which is funny because it's not like really a financial or investing lesson, but I think it is very much so an investing lesson when you look at venture capital and growth equity, is that management team matters so much, especially the earlier stage you go. There's just not a lot of data to look at. So, when you're investing in pre-seed, seed stage companies, it could be pre-revenue, it could be pre-product. We don't typically do a lot of pre-revenue or pre-product, but, even then there's, not probably a lot of financial traction yet. Like you're looking at a limited set of data. And so it comes down to how do you develop the pattern recognition and experience to know that this is someone who's actually going to be a good founder or not. And I think that was the most valuable thing I got from SoftBank, is being able to spend every week on like a Zoom call with Masa and figure out like, okay, what are the kind of founders that succeed, and seeing thousands of founders walk through our doors and being able to track them and see, okay, this is what it takes to be a unicorn founder. Oh, this guy didn't make it, or this gal is amazing and continues to crush it. Like that's kind of the most valuable thing I was able to get. And it's hard to distill into one lesson, but it's just kind of the pattern recognition that you develop over the course of like 10 years of seeing thousands of entrepreneurs, tracking them, meeting them, and figuring out like what elements of their personality are helping them and what elements of who they are and what they do is not really helping them, right?
Yeah.
So it's kind of finding, developing that sniffing that nose out, like sniffing out kind of entrepreneurs and founders and figuring out.
What are some patterns that you've seen, I guess, because you guys have talked to hundreds and hundreds of founders. Obviously, the ones that you guys have finally filtered through have become unicorns. So what's just kind of the common thread?
It's a couple of different things. And also what I will say is it's not just one size fits all, right? There's founders that succeed that are more technical, perhaps less salesy. There's plenty of founders that are extremely salesy, great at presenting, highly charismatic, that succeed as well. So there's no one archetype. What I would say though is there's a couple things I typically look for now when I meet with entrepreneurs. The first and foremost is a very, very deep-seated hunger and ambition internally to do whatever drives them. And they have a chip on their shoulder for whatever reason. They feel like they have something to prove to the world. And there's this deep, deep-seated hunger that they just are itching to scratch at and make sure that they're successful to be able to accomplish what they want to do. That is really usually the first thing I look for. So it's focus, determination, and like a, unwieldy amount of grit where they're just never going to give up and they're going to just continue grinding away at whatever it is that they're doing. The second thing I would say is, which I find usually quite helpful, is someone that knows how to present, to pitch, and paint a story. At the end of the day, as a founder, especially at the earliest stages, you've got to be able to sell. You have to be able to pitch to investors. You've got to pitch to your customers. You've got to pitch to everyone, honestly. And everyone's looking for something different, right? Like what a customer is looking for is different from what an investor is looking for. But you've got to be able to demonstrate and communicate the value of what you're doing. And so unfortunately, or fortunately, you do have to be, I think, a good salesperson across a couple of different constituents. So that's another thing that I usually look for. And then I think the two or three other things I look for are kind of a little bit less obvious, and sometimes, I think it depends on the situation. I do like to look for folks who are repeat founders, so they've been through the journey, hopefully once or twice. They know what it's like, they know what the pitfalls are, they know the pain and sacrifice it takes. So they don't have to be a serial entrepreneur that's had a ton of success, but ideally it'd be nice if it wasn't their first foray into entrepreneurship, because it is definitely tough for the first time around, as I've learned from starting my own fund. Like, it's a lot, and you can avoid a lot of mistakes. You can be a lot more efficient if you're doing the second time around.
Sure.
And then the third thing, or the final thing I'll mention, is when it comes to a founder, really being able to build a team and not being afraid, building an A team and not having an ego about it.
Yeah.
Because a lot of folks that I meet, a lot of founders, very strong founders, they often have a bit of an ego where they feel like, I've got to be like the head honcho, I've got to outshine everyone. And they're afraid to bring on team members that often could be more senior than them or could add a lot more value, a lot more experience than them. But they're afraid to bring them on because they're afraid they'll outshine and outclass kind of them as a leader. And I think that's a big red flag for me, because honestly, when you're building a company, you can't do it alone. You've got to have great people around you. You have to retain them as well. And I've seen a lot of cases where a company just doesn't find the best talent because there is a bit of that fear of, or maybe they're just not able to assess like who are the right people to bring on. But being able to sniff out the right talent, bring them on, retain them, I think that is extremely, extremely important as well. And I think you can often tell after meeting a couple of the team members at the company, you can tell how they think about hiring and retaining talent.
No, that's great. What are some of the things that you learned, building the firm, in terms of, maybe not so much on the strategy, because you've built that, but just kind of maybe professionally, personally, as you're, kind of like ideating your strategy. I'd say one big thing that a lot of managers are struggling with is differentiation. So what are some ways that you maybe recommend managers to differentiate themselves?
Yeah, it's an interesting question, because it's, there is an element of differentiation for sure, but for me, I've always believed that performance kind of speaks for itself, depending on who you're trying to cater to, right? Like if you're thinking about institutional investors or, financially driven investors where there's no kind of strategic, there's no strategic kind of angle to it. My view is that performance really speaks for itself over time. So my goal has always been, the North Star has always been deliver to great returns, great value to our LPs, and over time that will get recognized. Obviously to do that, you probably have to have something that differentiates you and makes you above average in whatever it is you do. So whether you specialize in a specific sector, specialize in a specific kind of thesis that no one else knows as well as you do, or you just have great sniffing ability of like what's a great founder, what's not. So you have great picking ability, or maybe you have a more operational focus. So you come in, you help these companies grow and achieve more because you're a former operator and you've got the team to really come in and dig in and help them grow. So I think there's a bunch of different ways you can kind of differentiate yourself. But ultimately, at the end of the day, when I think about it, it's like differentiation for the sake of differentiation, I don't think really makes sense. It's got to provide some sort of real value here. And the North Star, in my opinion, is always performance. And so you can sell, I mean, sure, it's great to be able to sell differentiation and maybe that helps you with fundraising. But after a while, you've got to deliver results.
So I'm going to go back a little bit to the earlier part of your bio, just getting into Harvard, working at Apollo, looking back, what's some career advice that you would give maybe college students that are trying to find their way? And, maybe advice on how to get into top schools. I don't know if there's, I know a lot of those top schools are looking at your essays, and they're looking at you being well-rounded. So maybe just general academic or career advice that you give to somebody just starting out.
Yeah, absolutely. I think, the advice that I would probably give is just to try a bunch of things out, because for me, I will either think about and evaluate what you want to do and what you might be a good fit for based on like that triangulation of kind of advice that I gave, or just go and try things, just do things. Because for me, I was never someone who could think about things and just be unbiased and like, determine what I wanted to do by just thinking about it. I had to go and try it, because I thought, oh, maybe I could be great at, working in sales and trading or working at a hedge fund. And it wasn't until I actually tried it that I realized, actually, you know what? I don't think this is exactly for me. And I wouldn't have guessed that venture capital actually was kind of my calling for the longest time, because I was thinking, oh, I'll be investment banking, I'll do private equity, it's going to be great. I'll just stay in that PE fund for a long time. And so I think once you try things, you very quickly realize, is this for me or is this not? So I think my advice would almost be just go and try things, because that trial and error is the only way, at least for me, it was one of the best ways for me to figure out what it is I wanted to do.
And then a couple more questions. So any advice for people going out and launching a fund? What are some of the pieces of advice if you were to be their big brother? And some of this could come from some of your learnings too, right? Maybe some challenges that you've had, and now that's a learning. And we're all going through a lot of different learnings every year. So,
yeah, it's tough, especially in this environment. I think there's just a lot less appetite for venture capital, especially from emerging managers. I think there's been a lot of data out there that's shown that capital coming into VC or growth from LPs has often gone to primarily, established multi-platform, like platform managers, like the Entries of the world. And so I think it really is, it's tough out there right now. And I think you have to really desire or know that this is what you want to do, because you're going to have to struggle and sacrifice a lot, I think, to get there. And so that's the first thing I would say before you take the leap into doing this. I think the second thing I would say is kind of figure out, like, what is your angle, what is your track record that you can really demonstrate to people, because it's really hard. Like, it's very, very hard to fundraise right now. And you've got to have something compelling and attractive for people to really be willing to commit capital to you, right? As it should be the case. I mean, I think the last, when it was 2021, 2022, I heard of fundraisers getting done super quickly and it being very easy to raise capital. But honestly, that's not the way that it should be. It should be relatively tough. And I think do give a lot of thought to like what your track record is, where you can point to, and what is unique about your strategy, or not necessarily unique, but what gives you the confidence that your strategy is going to actually perform versus anyone else, right? And that, I think, is core to figuring out kind of how you're going to go about doing this, because honestly, fundraising is probably the toughest part at this point. And setting, I mean, for me, I've worked in investing finance firms for a very long time. So setting up the firm, the operational back office, all that stuff, like it's annoying, but it's something that I can do relatively easily. If you come from less of a financial kind of background and kind of experience, you may want some help with that. So find the right advisors, lawyers, accountants that will help you with that, because it can be quite complicated if you don't come from that world. So yeah, those are kind of a few things I've put there.
You're doing community building, you're putting together really cool events. I've been able to as well. And I'm always happy to trade notes and share what works and what doesn't. But any secrets to, or just learnings in terms of building community and, even hosting a dinner, right? Like, I mean, any things to think about. And maybe I can start. I mean, one of the first things is obviously on the logistics side, like making sure you have a venue and, figuring out the cost. And obviously if you can't, pay for it, if your budget doesn't allow to do something elaborate, maybe partner with some, corporate partners that can kind of help cover that. And then I think part of it is, like, in my mind, like, just be very thoughtful in terms of like what the intention is of the event. And I always think about like what everybody gets, right? So like how do you entice them to come there? What value do you get attending? But would love to hear any nuggets if you were to kind of advise or mentor a fund manager to kind of build a community, or maybe do an AGM at some point. What are some maybe things that you've learned?
Yeah, no, it's certainly something that I think about a lot. So I think one thing I do very religiously is have regular communication to kind of the LP base, as well as just like ecosystem, friends and family, because honestly, like, people want to know what you're up to, and people want to engage. And one of the easiest ways to do that is to just say, here's what we're up to. Here's an event we're hosting. Here's the latest news that I saw that was kind of interesting. Here's the latest in our portfolio. And just like, the bar is actually so low, believe it or not. A lot of managers and a lot of funds just don't really communicate, and that's terrible, because your LPs, especially for your LPs, like, they've given you a lot of capital, and you have a fiduciary duty. Obviously, your duty is not necessarily to tell them everything you're doing, but someone kind of wants to know, like, what are you doing with our money, right? So I think that regular communication is actually really, I think, valuable to building community, building a sense of kind of like what you're up to. And that extends just beyond email as well, right? I have a lot of WhatsApp groups and text threads where, I'm just talking to people all the time in our ecosystem about what we're seeing. DeepSeek comes out, news comes out. I have a quick blurb of what's interesting there. What are my takeaways there? I think in this very distributed world, right, where we obviously all live in different places, technology is amazing to be able to allow us to communicate across borders, across thousands of miles, to be able to try to stay connected. So I do love in-person events as well, and I want to do more. But I think communicating just through other channels, I think, can't be understated. Or can't be overstated enough. Is also find ways to really communicate through digital channels. I think the other aspect is for in-person events. I like to do them as well. I try to keep them intimate, just because I think when it becomes a large event, then it becomes more of a brand and brand building marketing. But the smaller events, say like 8 to 10 to 12, like intimate dinners where you can actually have a meaningful conversation with the person to the left and to the right of you. I think those are great, just because, you get together people who have similar interests, similar focus areas, and you actually can have a meaningful conversation, right? It's not the 2 to 3 minute conversation. Nice to meet you. Here's what I do. And then you kind of walk around the room and do that, hand out your business cards to a couple of people. It's really like getting to know someone over the course of like a couple hours. And I think that is super valuable. So I found that when we do kind of more smaller, intimate dinners or breakfasts or events where it's like, 8 to 12 people, that's kind of been like my learning, the best kind of in Jeffersonian dinners.
I wrote a post about this like last week, so I thought it would, I've been to one. I haven't really done one. I mean, sometimes I'm a little self-conscious, right? Does it sound too cheesy that I'm prompting people? But I went to one recently that was good. And, I had a good memory of that event because we just kind of had real great, meaningful discussions. So if some people are able to pull it off, sometimes that's great. But to your point, right, if you got like 50 people, there's side conversations and people are talking over each other. So I think definitely when it's intimate, you got more of the focus with kind of a tighter group of people.
Right. Exactly. Awesome.
Well, hey, this was great, man. Really appreciate all your time, and learned a lot in a brief amount of time. And hopefully we get together and do some in-person stuff. And hope everybody else has a good rest of the day.
Awesome. Thank you so much,
Cool.
Joel. It's been a pleasure being on the show.
Yeah, absolutely. It was a lot of fun, and appreciate all that you do for founders, and really impressed with all your progress and your background as well.
Thank you.
All right. Take care. Bye, guys.